Hello, folks, and welcome to another FID day here on Tuesday, January 27th. And it is a chilly one. It's currently -9 degrees with the wind chill, and we aren't quite sure what's going to happen this week. If you look at the weather patterns, it's -7 and -9, I believe, Thursday and Friday. If you've already been in class and saw my presentation, at least the first 6 slides, then you can go ahead and jump to slide number 7 today. And I do have a bell ringer that I want you to answer. Answer the bell ringer after you watch this video on your notes. That's what I'm asking you to do. All right, folks, let's get right into this video. All right, everyone, welcome. Today we're diving into Chapter 5, National Income Accounting. This chapter helps us understand how economists measure what a country produces, who gets that income, and why GDP, which is gross domestic product, is such an important number. We'll also think about what GDP doesn't tell us about our well-being. Let's start at the very beginning. National income accounting is basically the government's way of keeping score of the economy. Think of it like a giant financial report card for the entire nation. It measures how much we produce, how much income is generated from that production, and where that income goes. When we talk about measuring output, we mean counting up all goods and services produced in a country in a year. But we don't just count anything, only the final goods and services. That's because if we counted everything, including the ingredients or materials used to make things, which are called intermediate goods, we'd be double counting. For example, if you bake a cake, the flour, sugar, and eggs are intermediate goods. The final cake that you sell to a customer is the final good. National income accounting makes sure we count only that final cake in GDP. On the income side, national income accounting tracks who gets paid. Workers earn wages, businesses earn profits, and the government collects taxes. This shows us not just what the economy produces, but how the money flows to people, companies, and the government. So in short, it's a snapshot of the economy, showing both production and income, which helps policymakers, businesses, and economists understand how the economy is doing and make informed decisions. Now let's talk about the circular flow model, which is basically a visual of how money moves through the economy. Imagine the economy is a giant loop. Money is constantly flowing between households and businesses. Households provide factors of production, like labor, land, and capital, to businesses. In return, they earn wages, rent, and profits, which is their income. That income doesn't just sit there. It comes back to businesses when households buy goods and services. That spending is called consumption. Businesses, on the other hand, produce goods and services and pay households for the resources they use. They also make profits, some of which they reinvest in their business, which is called an investment. And we can't forget the government and foreign sector. The government collects taxes and spends on goods, services, and transfer payments, while the foreign sector buys and sells goods with us, which are called imports, as well as exports that we send to them, which adds another loop to the flow. So the circular flow model is really a map of economic activity, showing how income, spending, and production are all connected. Every dollar spent ends up in someone else's pocket, and that keeps the economy moving. You can think of it like water in a closed loop, constantly circulating, never disappearing, just changing form and location. Let's break down GDP, the term that really pays the bills in national income accounting. Gross domestic product is the total market value of all final goods and services produced within a country during a specific period. Now, I want you to really understand final versus intermediate goods, because this trips a lot of people up. Final goods are products that are sold to the end customer, like a new car or a loaf of bread you buy at the store. These are counted in GDP. Intermediate goods, however, are used to make final goods, like the steel in the car or the flour in the bread. If we counted those two, we'd be double counting, and GDP would be overstated. Think of it like baking a cake. You only count the cake you sell, not each ingredient separately, because the ingredient's value is already baked into the final cake. That's what final goods and services mean. GDP only counts what's sold at the end of production. So GDP is the big number economists and policymakers watch to see how the economy is doing, because it captures the value of everything being produced and consumed. And remember, it's market value, which means we're talking in dollars, not in quantity alone, but in what goods and services are worth. Let's get crystal clear on the difference between final goods and intermediate goods, because this is a key to understanding GDP. Final goods are products sold to the end user or consumer, the ones you actually buy and use. For example, if you buy a smartphone, a car, or a sandwich, that's a final good. Its value goes straight into GDP because it's ready for consumption. Intermediate goods are the inputs used to make final goods. Think of steel that I talked about to use to build a car, flour that we talked about to bake bread or a cake, microchips used in a smartphone. These goods aren't counted separately in GDP because their value is already included in the final product. Counting them twice would be like counting the flour and the bread. Economists call that double counting, and it would make GDP look bigger than it really is. Here's a simple analogy. Imagine you're building a Lego set to sell. The finished Lego castle is the final good. The individual bricks you use to build it are the intermediate goods. We only count the castle in GDP because it's the finished product people are buying. So whenever we talk about GDP, think we only want the finished products, not the ingredients or the parts that make up the finished product. This keeps our measurement accurate and meaningful. This equation is your best friend for the rest of the year. So pause the video, make sure you have it copied down. Let's understand it. GDP equals consumption plus investment plus government spending plus net exports. Everything we talk about, recessions, inflation, policy, connects back to this formula. The hardest part isn't the math, it's classifying spending correctly. If you mess that up, the whole answer falls apart. So this is the spending approach to calculate GDP. It adds up all spending on final goods and services in the economy. There's your formula. GDP equals C plus I plus G plus X minus M. So let's piece this together. Consumption, the C. This is the spending by households on goods and services. Everything from groceries and haircuts to cars and video games. It's usually the biggest part of GDP because people are always buying stuff. The I, investment. It's not stocks or bonds here. We mean spending by businesses on capital goods like machines, tools, factories, and also housing construction. It's the part of GDP that adds to future production capacity. Think of it as the economy planting seeds for tomorrow's growth. G, government spending. This is what federal, state, and local governments spend on goods and services, like building roads, paying teachers, or funding national defense. Important note here, transfer payments like Social Security aren't included here because they're just moving money around, not paying for new production. Then there's the X minus M, or the net exports. This is exports minus imports. Exports are goods and services sold to other countries, adding to our GDP. Imports are goods we buy from other countries, which we subtract because they're produced elsewhere. So when we add it all together, GDP measures the total value of final goods and services produced within our country. One way I like to explain it is this. Imagine the economy as a giant pie. Consumption is the slice we eat today. Investment is the slice we save to grow that pie. Government spending is the slice the government uses, and net exports are the slices we trade with other countries. Together they make the whole pie, or GDP. Now, if you were in class for the first 6 slides, this is where you should be beginning. So let's dive into consumption, the biggest piece of the GDP pie. Consumption is all the spending by households on goods and services. This includes everything from your morning coffee to a new car, from streaming subscriptions to haircuts. Basically, it's a household buy for its personal use. It counts as consumption. It's important to understand that consumption is after-tax spending, meaning it comes from disposable income, the money people actually have left after paying personal income taxes. That's why knowing disposable income is key. It tells us how much money households can actually spend. There are 3 broad types of consumption. Number 1 is durable goods, things that last a long time, like cars, appliances, and furniture. Then we have non-durable goods, things we use up quickly, like food, clothing, or gas. And then we have services. These are activities we pay for, like healthcare, education, or entertainment. Think of consumption as the fuel that keeps economy running. Every dollar spent flows into someone else's income, which they can then spend again. That's how GDP keeps circulating. If people spend less, it's like turning down the flow of fuel. GDP grows slowly. So when we talk about consumption and GDP, we're not just talking about shopping, it's the engine that drives most of the economy. Now let's talk about investment, which GDP terms doesn't mean buying stocks or bonds, as I mentioned. It means spending on things that increase future production. Think of it as the economy buying new tools, equipment, or buildings to make more goods and services down the line. There are a few key types you need to know. Number one, business investment. Firms buying new machinery, tools, or factories. This is about building capacity. The second is residential investment, new homes and apartment buildings. This counts because houses provide services over time. And the third one is inventory investment. When businesses produce goods but don't sell them right away, they go into inventory. That's still considered investment because it adds to GDP today. We also distinguish between gross investment and net investment. Gross investment is all spending on new capital, including replacing worn out equipment. Net investment subtracts the depreciation. Basically, it shows how much the economy's productive capacity is actually increasing. Investment is like planting a seed in a garden. Some seeds replace old plants, some grow new crops. If we only look at the seeds that replace old plants, we might think nothing new is happening. But the garden's total growth depends on both replacement and new growth. That's why gross versus net investment matters. Investment is crucial because it affects future GDP. Today's investment becomes tomorrow's production. If it helps produce future output, it's investment. Now let's talk government spending, which is the total expenditure by federal, state, and local governments on goods and services. This is a key part of GDP because it represents money flowing into the economy that isn't coming from households or businesses. Government spending includes things like paying salaries for public employees, which are teachers, police officers, firefighters, and clerks. These salaries get spent and circulate into the economy. Then there's purchasing goods and services like military equipment, office supplies, or infrastructure projects. Then we have public works projects, buildings, highways, bridges, and schools, which adds to the productive capacity of the economy. It does not include transfer payments like Social Security or unemployment benefits, because those payments aren't buying new goods or services. They're just moving money from one group to another group. Think of it like a parent giving money to their kid to spend on their own toys versus buying the toys themselves. Only the actual purchase of the toys adds to GDP. The transfer of money doesn't. Government spending matters because it can stimulate economic activity, especially during recessions, by putting money directly into the economy's hands and keeping the circular flow moving. Net exports is the value of a country's exports minus its imports. It's how much money we earn from selling goods and services to other countries compared to how much we spend buying from them. Exports are goods and services we produce domestically and sell abroad, like airplanes, software, or agricultural products. These add to GDP because they are produced here and bring money into the economy. Imports are goods and services we buy from other countries, like electronics or clothing made overseas. These subtract from GDP because the money spent doesn't go to domestic producers. So the formula is net exports equals exports minus imports. Think of it like running a lemonade stand. If I sell $50 of lemonade to my neighbors, but buy $20 of lemons from someone else's stand, my net earnings that count for my stand GDP is only $30. Net exports can be positive or negatives. If there's a trade surplus where exports are greater than imports, that adds to the GDP. If there's a trade deficit where imports are greater than exports, that subtracts from the GDP. It's important because it tells us how connected our economy is to the world, and it affects the total demand for our goods and services. GDP misses a lot, and that matters. Buying a used car doesn't count because it was already counted when it was first produced. Stocks and bonds don't count because they're financial claims, not production. Work done under the table, like babysitting for cash, usually goes uncounted. And if I cook dinner at home, GDP ignores that. But if I go to a restaurant, suddenly GDP rises. That tells you GDP measures market activity, not total value. So remember, GDP only counts new final goods and services. Okay, now that we know what GDP measures, we also need to understand what it doesn't include. GDP is powerful, but it doesn't tell the whole story. So number one, intermediate goods. These are goods used to make other goods. For example, I've used this over again. Flour used by a bakery to make breads or cakes isn't counted separately in GDP because the final bread already includes the value of flour. Counting both would be double counting. 2. Used goods. GDP only counts production that happens in the current year. So if someone sells a used car, that sale doesn't add to this year's GDP because it was counted when the car was first sold as new. Then we have financial transactions. Things like buying stocks or bonds aren't counted in GDP because they aren't payments for goods or services being produced. They're just transfer of ownership of existing assets. Number 4 is the underground economy. This includes legal activities that aren't reported, like babysitting for cash without a receipt, or illegal activities like drug sales. These activities don't show up in GDP, even though they involve production and income. And number 5 is non-market household production. Activities like cooking your own meals, cleaning your own house, or taking care of family members don't count in GDP because no money changes hands, even though these are real contributions to economic well-being. So again, think of GDP like a scoreboard for a game. It tells you the points scored, but it doesn't show you practice sessions, team spirit, injuries, or how fun that game was. GDP measures economic activity, but it doesn't measure all things that make life meaningful. GDP is a powerful tool, but it doesn't capture everything that affects our well-being. GDP is useful, but it doesn't measure everything that matters. That's the key takeaway here. Now we need to understand nominal GDP versus real GDP. This is super important because it tells us whether our economy is really growing or if prices are just going up. Nominal GDP. This is the total value of all goods and services produced in a country measured in current prices. So if prices rise from one year to the next, nominal GDP goes up, even if we didn't actually produce more stuff. Think of it like taking the price tag at the store today and multiplying it by the number of items sold, without worrying if those prices are higher than last year. Real GDP, this adjusts for inflation. It's the total value of goods and services measured in constant prices from a base year. By keeping prices constant, real GDP lets us compare actual production over time without getting fooled by price changes. It's like saying, if prices were the same in 2010, how much stuff did we really produce that year? Imagine if I sold you a burger in 2026 for $10, but in 2025 that same burger was worth $8. If we just look at the price today, it looks like I made more money, but in terms of the actual burger I sold, the quantity hasn't changed. Real GDP is telling you, ignore the price jump, just look at the real amount of burgers. So nominal GDP measures money spent at today's prices, while real GDP measures the true quantity of goods and services produced, keeping inflation out of the picture. For our AP exam, remember, real GDP equals the more accurate picture of growth. Nominal can mislead you if prices are rising too quickly. A base year is just the year we freeze prices. We pretend prices never change and recalculate GDP. The specific year doesn't matter. Consistency does. Once prices are locked in, changes in GDP reflect changes in quantities, not prices. That's the whole point. The base year is the year we choose to hold prices constant when calculating real GDP. Think of it as our anchor year. By using base prices, we can compare output across different years without inflation getting in the way. We're asking how much more stuff are we producing, not how much more expensive did stuff get. The choice of base year doesn't change trends. It just gives us a consistent yardstick to use. Now for this slide, this is where our bell ringer comes into play, which is why I asked you to wait until you watch the video until you answered the bell ringer. GDP per capita is GDP spread out per person. It gives us a rough idea of average material living standards. It's why smaller countries with lower GDP can still be wealthy, but averages hide inequality. 10 billionaires and 10 people with nothing still average out nicely on paper. To find GDP per capita, you take the total GDP and divide it by the population. It gives us a sense of how much, on average, each person is producing or contributing to the economy. GDP per capita gives us a rough idea of average material living standards. It tells us how much output there is per person. GDP per capita helps us compare living standards across countries in ways that make more sense for individuals. You can think of GDP like a big pie. GDP per capita is like cutting that pie into slices and seeing how big each slice is. A bigger pie doesn't always mean bigger slices if there's a lot of people sharing it. It doesn't measure happiness or equality, but it's useful for comparing countries or tracking changes over time. To find our GDP capital, all we're taking is the GDP of a given year and dividing it by the population. So if the GDP were $21 trillion and our population in the United States is 330 million people, we would take 21 trillion and divide that by 330 million, which gives us $63,636 per person. Next, we have depreciation. Depreciation is the value of capital goods, like machines, equipment, or buildings, that gets used up or worn out in the production process each year. Think of it like your car. The more you drive it, the more it loses value, and eventually you'll need to replace parts or even the whole car. The same idea applies to the tools businesses use to make goods and services. When we measure GDP, we're counting total production, but some of that is just replacing old or worn out equipment. It isn't really new production for the economy to enjoy. Subtracting depreciation from GDP gives us net domestic product, or NDP, which tells us how much new output is actually available after maintaining our existing capital. So depreciation matters because it helps us see the difference between what's just keeping the economy running and what's actually creating new value, like extra goods or services that people can consume or invest in for growth. Think of it like owning a car. Even if you drive a lot, part of the value is just maintaining what you already have. Now let's talk about net domestic product, or NDP. NDP is basically GDP after we subtract depreciation. Remember how we just talked about depreciation, the part of our capital that's worn out each year? Well, NDP tells us how much new usable production we actually have after replacing all that worn out equipment and infrastructure. Think of it like running a lemonade stand. If you earned $100 in sales this year, but $20 of that is just covering the cost of replacing your old juicer and cups, which is your net gain, the amount you really added to your stand is $80. That $80 is like NDP for the economy. It's the new production that actually increases our living standards. NDP is useful because it gives policymakers and economists a clearer picture of how much the economy is really growing, beyond just keeping the machines running. It helps us separate maintenance from true growth, which is crucial when planning for investment, saving, or economic policy. Take this point away with you. Net domestic product tells us how much we can consume without reducing our ability to produce in the future. By subtracting depreciation from GDP, we see how much output is truly new after replacing worn out capital. Folks, that takes us to the end of slide 16. We still have 10 slides to review. In the event of another FID tomorrow, then what we'll do is we will go ahead and finish those slides tomorrow. I did promise you a 15-minute video. Unless, of course, you were absent, then you had to watch the whole video so that you understand everything that we're doing. Again, some of this sounds redundant, but I'm trying to get this into your mind so that you remember it for the test. On a final thought and note, if you are still listening this deep into the video, for the bell ringer, when you go to complete it, all I want you to do is put Japan 6767 6-7. That's right, 6-7. If you write that, then you're getting the bonus. And what I'll do is I will take the number of students in class, like per capita GDP, the number of students in class reflects how much bonus there is, and however many people get it, that's what we'll divide it, and that's who will get the bonus. All right, ladies and gentlemen, stay warm today. See you tomorrow.